Welcome to Treasury 360 with me, Koduah-Sarpong. Today we are out and about discussing the revocation of licenses of fund management companies. Now this has become a serious topic for the investing public, mainly because after the revocation of licenses of banks, savings and loans, microfinance, now is the turn of the fund managers. And these are the places where most people want to invest their cash. So today with me is the founder and chairman of Sarpong Capital, Mr. Kofi Koduah-Sarpong, who will be discussing the topic of the revocation of licenses of the fund managers. Okay, so welcome, Mr. Chairman and founder.
Right, thank you.
How's the market? How's the turbulence?
It's been quite turbulent, if you put it that way. A lot of fund managers having their names included on this revocation list. A lot of investors also panicking around whether to take their money out of the existing ones or not. And where they are not taking their money out of existing fund managers, they are worrying how do they get their money back from the ones who've been revoked. So it's been quite a chaotic couple of days, and we hope to see how it unfolds.
Well, so for us, we may know what fund managers are or what they do, but who are the fund managers and where from this?
Right. I think first to understand who the fund managers are, you need to understand what they actually do.
Yeah.
And many a times you hear people saying investment banks or investment managers or investment advisors. Mm-hmm. So it's important to put that into perspective. So I think we'll start from investment banking. Investment banking is a very broad discipline that covers corporate advisory, it covers capital markets, and it covers fund management or investment management. And that's where many of the investment managers and investment advisors take their core mandate as to what it is they do. So basically, if you think about it, if corporate advisory is the side of the business that actually goes out looking for money for corporates and businesses, then it only stands to reason that the investment managers are the ones who bring the capital to the clients that are actually looking for capital. So in essence, an investment bank brings two or three different disciplines together to bring capital to also together. So that's what investment banks do. So if you hear investment bank, you need to ask yourself a question: is it a full service? Full service means they have corporate advisory, they have capital markets, and then they have investment management. Mm-hmm. But where it's not a full service investment bank, then you can actually talk about them in their respective disciplines. So an investment manager or a fund manager is just a fund manager. They are not an investment bank. Okay. If you talk about just a trading house or a brokerage house, it's just a brokerage house. Or if you talk about a corporate advisory firm, it's just a boutique advisory firm. So it's either they're together, then you call them investment banks, or if they're doing their separate ones, you just call them by their discipline names, investment managers or corporate advisors.
Okay, so what's the difference between that and a bank?
Okay. Right, so the difference between an investment bank and a traditional bank or a commercial bank is basically the core function. A commercial bank or a traditional bank does deposit taking. Yeah. And investment banks don't take deposits. They provide investment management services, but it's not deposit taking. So that's the broad difference. And a traditional bank or a commercial bank will provide things like a checking account, which is where you can draw your checks out. And they also provide things like these credit cards and stuff like that. So that's really where traditional banking is. Investment banking is more high-touch, large-scale transaction or transaction advisory stuff that they do. So when you talk mergers and acquisitions, you talk sales and trading or proprietary trading, and you're talking wealth management or high net worth wealth management, then you're talking about what investment banks do.
Okay. So investment banks still have access to the public's or general public's funds.
Yes.
So where do they keep it? If they are not taking the deposits, it means that the deposits don't sit with them, but they are making decisions on these deposits. Where do they keep the
Fantastic. To make a very complex activity simple, you're talking about the relationship between the investment manager as a fiduciary entity or an agent who provides fiduciary service, meaning they're accountable to their clients and how they actually keep the money. Basically, we're talking using stuff like custody accounts.
Okay.
Or if you are a brokerage house or a trading house, then you're talking the nominee or street name accounts, or the CSD accounts. So the CSD custodians or the nominee accounts are various ways in which the public's money gets to be stored or recorded somewhere, and it's not commingled. The key thing is it should not be commingled with the firm's own funds. So you really do need a custodian in place. You need some sort of nominee account in place to hold securities or to hold cash on behalf of your clients.
So why is it that the general public is saying, where's my money, and they are asking for it? The money is not sitting with the investment banks or the fund managers. It's sitting with someone, or some other entity.
Right.
All right. They have control over it. So why is the spotlight just on the fund managers?
Okay. So the relationship here is very, very simple. The custodian is only a custodian. They're just holding either the securities or the cash on behalf of the client in the firm's books. So one of the splendid ways that securities laws are drafted is that you need to keep what we call, there's a section in the Act, a trust account or a custody account. It's a third-party account, so that you put all client monies in those particular accounts. So that's the first step. Then when investment decisions are made on behalf of the client, they instruct the custodian firm to release the funds for the purpose that has been agreed or established in the investment arrangement. So the custodians are just that, they just hold custody. So I personally, or I think the industry will agree that the custodians are not part of this issue.
Okay. When there's trouble, we want to rope as many people in as possible. So we tried. Custodians didn't work. But what about the trustees? Now, trustees have to do with the pension funds.
Yes.
Every working person has some pension that is sitting with the trustee that is also mandated to sort of keep watch over this fund. So can we rope the trustees in?
I don't think you can rope the trustees in either. Why? Because that's what he is. He's a trustee. He's holding it in trust for you. He only provides a legal structure for your funds to be held separately from your normal pension, from your tier 1. So tier 1, tier 2, the pensions per the Pensions Act, tier 1, tier 2, tier 1 goes to SNIT, and tier 2 goes to the trustee or the pension fund or the pension administrator, if you like to call it that way. And they hold it separate from their own funds as well. And then they also are guided by an investment policy as well, statement and investment guidelines as well. So what you realize is that many trustees have what we call these funds or the sub-funds. So you probably have XYZ trustee, who's a pension fund, and they've got a sub-fund that your money goes into. And that sub-fund may have particular characteristics in terms of how the money is invested, whether it's buying just treasury bills or money markets, or it's buying long-term bonds, or it's buying a mix of those.
Okay.
And it's guided by...
We'll get to the workings of it. What I'm trying to do is to say there's a problem, who and who caused the problem? And I'm trying to rope custodians in, trustees in, because they are in the ecosystem with the fund managers. And apparently, so the trustees appoint the fund managers.
Yes.
Okay, so if they've appointed the fund managers, how are they not part of the problem?
Well, again, there too, there's what we call the fiduciary role. And your funds are held in a pool with other people's money. And the trustee is administering that on your behalf. And hopefully in a defined contribution pension fund is what you put in, is what you're going to get out at the end of the day. So for me, in many corners of the industry, the trustees are called what we call asset owners, effectively, even though they hold it on behalf of their clients, they are really the asset owners, because from that point onwards, they control what gets done with it. So it is, if you're a pension fund and you don't administer your client pension fund money properly, you best bet nobody's going to be bringing money to you.
Yeah.
So there's a natural selection going on there. If you perform badly or poorly, they'll move their money away to another tier 2 fund manager, pension fund, and you no longer have the benefit of managing that pool of money. So in my opinion, I don't think that they have done anything wrong. They're also investment professionals. They rely on the advice of the fund managers as well in terms of making investment decisions. And largely, that's why the SEC and the NPRA require you to have a licensed fund manager as your fund manager. You can't have any Mickey Mouse fund manager who has no standing in the industry or has no business being a fund manager to take those monies away. You're going to lose your license as a fund manager. Sorry, as a pension trustee, and as a fund manager, well, nobody's going to bring you business as well.
Okay. So what I'm trying to capture is there's a problem with fund management companies, and the SEC has withdrawn licenses. Now, these fund management companies work with trustees and custodians, and what Mr. Sarpong has explained is that the custodians keep the funds, the trustees appoint the fund managers, and then the investment goes on, and the trustees keep watch over your money. And that's if you are running a pension fund. Okay, so what about high net worth individuals? Now these individuals, okay, we'll bundle them up with institutions, institutional funds. They don't have to necessarily go through a trustee. They can decide to bring money to a fund management company and have it. So high net worth individuals, institutions. Now, when these people bring their money to a fund manager, does it still go to a custodian? The fund manager still doesn't house the money?
Okay.
How does that work?
All right. It's interesting you mentioned high net worth institutions, because when you think about it, even the pension fund together is an institutional investor. Okay. So you can look at it as one entity or a very large high net worth client. Yeah. So that is why I try to point out that they are not really at fault, because they themselves are bringing money, assets to a fund manager to invest on their behalf. So that's how come you can isolate them from the problem. Back to your question. Now, in ordinary asset management, fund management roles, relationships, you do require a custodian to be in place to hold the client assets until it is ready to be deployed. So by doing so, you are separating it from your net own firm funds, so they are not commingled, and that's a cardinal no-no in investment management at any level, whether it's high net worth or whether it's retail level investment management. The no-no is do not mix client money with your own money. You've got a big problem waiting to happen, because at what point in time do you know when the car you're buying for your firm is actually coming out of clients' money? That is the key reason we separate the funds using either a custody account or a trust account held at a third-party bank. So in this
a commercial bank.
Yeah, it's a commercial bank.
Okay.
Apologies, a commercial bank. It could be a commercial bank, a saving room, so long as it is a bank of some sort. You're able to separate the cash.
Okay, so high net worth individuals and other institutions aside the pension fund money, they now walk to a fund management company and says, I have this amount of money, I need you to invest.
Yes.
Is that a relationship?
Yes.
Okay, so who is the signatory or authority on the funds that are sitting with the commercial bank or savings and who signs up for that?
Okay, so the custody relationship is normally held between the custodian bank and the fund manager first and foremost. But the custodian bank appreciates or acknowledges that those funds going into that account are not for the firm.
Okay.
that is the real relationship in that custody arrangement. So for any movement of cash out there, there has to be accompanying instructions with the movement or the request to move money. So normally many firms would have what we call an investment policy statement or policy agreements in place between their clients.
Okay.
So
and they share it with the custodian?
Of course, it needs to be something, it's a document that governs the relationship. So if the custodian is holding account 225 on behalf of Koduah-Sarpong, but it was brought in by maybe Kofi-Sarpong as an associate's fund manager, and there's an investment policy saying that Kofi-Sarpong's fund Koduah-Sarpong's fund should only be used for equity purchases, and you are sending instructions. I send instructions to them to go and buy bonds. Obviously, that is in conflict with what the instructions that have been laid down per the agreement between the three parties.
I'm still trying to rope the custodians in, okay. But okay, now here's a scenario. Some of the reasons why SEC ascribed to withdrawal of the licenses was that I think there was some investment in unlisted equities, you know, and private placements. Okay, so does it mean that it was in the investment document that they could purchase private placement, or they could go for unlisted equities?
All right. I mean, this is where it gets more interesting. First and foremost, you need to understand how the clients took their money to the firms, the investment firms or the fund managers. In many cases, it went to these firms as fixed deposits.
Are they supposed to take deposits?
Unfortunately, no, they are not.
So how are they giving out fixed deposit if they are not supposed to do that?
So and then comes problem number 2. By taking fixed deposits, they've gone contrary to part X of the SEC compliance manual, which says don't guarantee returns.
Let's look at this fixed deposit, please. Now, for me to bring a fixed deposit to an investment firm, they have to have advertised it to say that I'm giving out this interest rate per annum.
Fantastic.
All right. So, did they entice the public?
Again, problem number 3, advertising. In the compliance manual and in the law, you are not supposed to overtly advertise guaranteed returns of any sort to the investing public.
So how did this happen, and how did it become so rampant? The thing is against the law. We are not supposed to do it. So what? Customers come knocking and say, "Give me 25%," and you say, "Okay." How does it work?
So if I have to be very, very honest,
and you have to be. This is 2060. We have other professionals watching.
I have to be very honest here. Is that in the past, many individuals saw the fund management license as a cut down or a cost-effective way of doing the business of retail banking. Yes.
Okay.
And that is where that practice comes from.
Cut down because of
the capital requirements.
I think the capital requirements.
Yes.
It was 1 billion cedis.
100,000. Yes.
Which tends to 100,000
exactly.
now. And since 2007, when we changed or we did the redenomination, nobody thought to review it. I was looking at the document and it still says 1 billion cedis. And so that was a cheap way of setting up a company to collect funds from.
To do deposit taking, effectively.
Okay.
And that's the genesis of the problem. Seeing it as a very cheap way of entering the business of deposit taking. And that's what really has spurred the problem.
So one big problem was deposit taking when they were not supposed to.
Exactly.
So when they do that, it means the money doesn't end up with a custodian, does it?
Yeah, in many cases it won't end up with a custodian.
And if it doesn't end up with a custodian, it becomes their money.
Yes.
And if it's their money, then they can do private placement. They can do, my friend wants to set up some shoemaking business, and so get this money, and then when you, is that what?
You're very right.
Oh goodness. Okay, so it's interesting. We are talking to Mr. Kofi-Sarpong of Sarpong Capital. and he's taking us through the in-depth about the problem that arose for SEC to now withdraw licenses of several fund management companies. Now the discussion is becoming very interesting, and we're trying to paint a picture so that the investment public would understand what's going on and who to trust with their money. Okay, so my next question is, if I walk into a fund management company and they promise me a certain return, does it mean that I didn't sign any investment policy? It means that didn't come in at all.
Well, if you walked into an investment firm who offered you a fixed deposit and you took money, no, you didn't have an investment policy in place, number one. Number two, the other thing that you don't have is there are no risk management frameworks in there to govern how your funds are going to be deployed. So they won't. The manager doesn't have to adhere to any thresholds when putting your money anywhere. They can put it in anything. If their brother comes and says we want to borrow money, yeah, they'll lend it out to them and take an interest spread.
Goodness. So where was the regulator in this?
The regulator was around.
It was around, but so is it just people being ingenious, or it was an opportunity that people took and has been abused?
Well, I like to put it this way. It's more of financial innovation. Okay. I take it from a financial innovation point of view, because when there's when there are loopholes in your laws, that creates regulatory arbitrage. And when there's regulatory arbitrage, people will take advantage of that.
One person sees it, two people see it,
exactly.
Two people see it, and
then it becomes a systemic issue. And this is a very, very systemic issue, because now you have interconnectedness cutting across from the fund management side to savings and loans, microfinance, banks. So just have any small or any minor issue in any of those particular sectors, and then it trickles down and knocks on to them, which is what invariably happened. So I took a fixed deposit from you, and then I put it in a fixed deposit with a savings and loan, which is supposed to take fixed deposit. I put it in a fixed deposit with a bank, which is supposed to take do fixed deposits, and then unfortunately their license gets revoked, and now I'm stuck. Yeah, I have to speak with the receiver, who's going to probably give me about 30 or 40, 50% haircut on whatever money went in as a fixed deposit. Now, that's the thing. When you issue a fixed deposit, you are making a claim against the firm itself directly. Okay. So it is what assets the firm has that they're able to liquidate in order to pay you. Okay. So if they can't get sufficient assets to liquidate, guess what's happening? You're not getting any money. Yeah. So that's why the SEC was very, 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 very vocal about fund managers not taking or promising fixed returns or taking fixed deposits. In fact, to be honest, they issued out circulars. To be fair to the regulator, they did what they ought to have done. In 2015, they issued a circular on the matter. 2018, they brought out another circular and even gave a timeline for firms who had issued fixed deposits to their clients to transform them from fixed deposits into portfolios that are being managed separately. That timeline elapsed, so the sunset on that particular grace period, and
still going on.
Or it was going on to some extent, and then the savings and loans and microfinance revocations also happened, and what you realize is that that's where the highest yield is, the microfinance and then the savings and loans. So many of these fund managers plug money into these.
Okay. So now we have a clear understanding of what went wrong. So what if I actually got an investment, what do you call it? Policy statement.
Yeah.
So it means that I know where my funds are sitting. My custodian knows where my funds have gone.
Good.
Okay. So we don't want to bundle everybody up as everybody went to get a fixed interest rate or whatever from the fund managers. Yeah. So I have an investment policy, and it spells out what's happening. So I went through the right channel.
Yeah.
Do I have access to my funds?
There you're going to face another issue altogether. Now, the investment policy statement does one very important thing. It sets out an asset allocation table for how the funds are going to be invested. And then it also states whether the funds being managed are being managed on a discretionary basis or a non-discretionary basis, meaning who has control to do what. Must the investment manager come to the client every time they come up with an investment idea to seek approval, or in where the investment manager has the power to do that on their own, they can just go about doing their business. So it's very important to understand
the policy statement.
First, discretionary versus non-discretionary, and then the policy statement and its allocation table.
Okay. So, but I take it a majority of those who have their funds locked up were not going this route.
Well, I can't speak for everybody or the whole industry as a whole, because even within those, well, let's say the institutional or the high net worth investors who had investment policy statements, you may find that their funds were put in a particular asset class that was exposed to an industry or a sector that is facing some turmoil, i.e. savings and loans, microfinance, or the banking sector. So if you had a portfolio that had some exposure there, they had placed the money in the asset class that was for money market and cash deposits, with a fund that, savings and loans, or a bank that is no longer in existence or has been transformed into a different entity, then you best believe that it's going to be a while before you're going to be able to yank that money out of that particular investment.
Okay.
So that invariably creates some of the problems for some of the fund managers. Many of the fund managers had exposures to savings and loans and microfinances whose licenses have been revoked. So that's where really the core issue is.
Okay, so in a nutshell, people invest, the first line or the first breach was the promising of fixed returns.
Yes.
Right? And then when that happened, then whatever else is out of control.
Yes.
Because now the systems that were placed around investment banking to protect depositors or clients, not depositors. Investors.
Yes.
Those things to protect them were breached.
Yes.
Okay. So now, what's the way forward? What people's funds are locked up, and some. Okay. First of all, the investment bank can lose the funds, right? If it's in equities and it's poorly performing.
Of course, you lose capital.
Okay, you lose capital. Okay, so is there a separation of I lost capital or I lost your money?
Well, it's the same. They're the same. I lost your money and I lost capital is the same. Let's say I bought 50 CDs worth of shares on the stock exchange today, and at the price of 50, and all of a sudden the share price tumbles down to 30. What's happened? I've lost 20. So I've lost 20 CDs of your money in that particular investment.
Yeah, but you'll still be alive. I can now say,
30,
give me the rest.
Yeah, I'll give you 30. I've lost money and I'll give you 30. I'll give that back to you.
Okay.
And that's the basic investment tenet. I mean, you don't guarantee anybody. Investment carries risk. As much as it carries reward, it does carry risk. And that risk is you can lose some or all of your money. So imagine you had, UT Bank. You had UT Bank shares, and you bought it back in the day when it was trading at maybe 80 or 80 CDs or yes, 1 CD or whatever it is. You bought 50 worth of those, and then you kept holding it with so much belief. And August 2017 happens. Their license is revoked. In fact, they were delisted. Their shares would stop trading on the stock exchange at some point in time, and it's worth zero now. That's a total loss of capital. It's gone. Nobody's going to give that money back to you. That's the risk you took. That's the risk you took by going into the equity market. Now, if you wanted
some money back, didn't go directly into the equity market. It's the fund manager that
Well, the
Okay,
investors
they
didn't
signed
go
this-
directly
yeah.
there, but they took advice
Okay.
from fund managers, and then they invested their monies either on a discretionary basis or a non-discretionary basis. So at the end of the day, the net result is you have lost your money, and it's gone. Unless maybe some we don't know, maybe they were giving shares in GCB. If anybody was giving me, I'll be happy. I'll take this. But the reality is, when a company goes out of business and they're listed, their stock price is zero at the end of the day. So if you have any money in there, it's gone.
Okay, okay. This has been Treasury 360, and we've been discussing with Kofi-Sarpong, chairman and founder of Sarpong Capital, what happened and where is your money, and well, generally in this industry, what to do when you want to invest with an investment firm. Now, the discussion should go on. We should have more time with Mr. Sarpong. But before we wrap up, we have something special here, which is by Lavish Gifts and Packages. And this, okay. This is for you.
Is it the one that we all like?
I wonder. This is
Thank
for
you
you
very
from
much.
Lavish, and you should
Thank you, Lavish.
contact Lavish for your packages for Christmas, your hampers, and all that. Thank you for watching Treasury 360.